Hi everyone, welcome once again to our channel. Okay, today I had told you all that today we will be doing capital budgeting. Okay, capital budgeting is one of the most important chapter of financial management, financial management and strategic management paper. Okay, module 2. Okay, paper number 8. So, capital budgeting basically, if you see, it is your second chapter in FM. Okay, now that chapter is this particular chapter is very vast. It has got a lot of theory. It has also got a lot of practicals to be solved. Okay. This chapter, if you will do at least your 15 marks of this entire FM out of 60 marks, 15 marks is only from this chapter. There are some as well as theory questions being asked in the past exam questions papers also. Okay, so I am going to revise this particular chapter with the help of a basic problem. Okay, some basic questions, what is to understand what is capital budgeting, and then based on that we will be solving our past exam questions. Okay, so let's begin. Capital budgeting. Okay, to understand what is capital budgeting, basically it is talking about the investments made by the company. Okay, investments made by a organization, by a company in form of capital assets. Okay, now capital assets are those assets which are going to be they have a huge amount of investment. They are going to bring the fruits of using that particular assets over the years to come. These particular expenses, capital expenses, okay, are not something which are to be done on year to year basis. They are done on once in a given span of years. Okay, so a very important and well informed decision has to be taken by an organization. Now, how will this decision come? If I'm talking about, say, I am investing in a plant and machinery. Plant and machinery will involve a cost. Okay, it will also include depreciation. Every year in the form of depreciation, there will be a cost which will be put in my P&L. But along with that, this plant and machinery is going to help me into my production. It is going to help me in my inflow. Okay, so though the expenses are going to go move out, there will be an inflow due to which my profits, there will be cash inflow. Okay, due to which my profits are going to rise because obviously I will be operating, doing my business with the help of that particular capital asset. Okay, so importance of capital budgeting is to understand all the long term implications. Involvement of large amount of funds is there, therefore capital budgeting is very important to assess and understand how much investment should be made, understand the life of the asset. Okay, it is an irreversible decision. Once that decision is taken, you cannot really go back and say that okay fine, now I don't want this particular plant and machinery. You have already bought, you have already paid. Okay, there is a lot of risk and uncertainty involved and it is difficult to make. Okay, so that is why capital budgeting becomes very important. Now, kind of capital budgeting decisions, okay, when all these assessments are done, okay, we get a report as to whether we should move ahead with a given particular capital asset. Either we accept the project, we reject the decisions. Okay, there can be mutually two exclusive decisions where both the things we want to consider, and there can be a capital rationing decisions. Okay, so capital budgeting is a process with the help of which we need to understand how much are we going to invest today and how much is going to be our inflow in the near future, in the near given number of years. Okay, so when we will do the practical questions, there are two important things which will keep on coming. Okay, two important words. One is net present value, one is internal rate of return. Okay, all these things are going to matter. Internal rate of return, we have always been talking about the cost of capital, the amount of return on an investment. Okay, so if a given company, I'm telling you, they are providing a rate of return on their investments. Okay, rate of return. internal rate of return is 10%. Okay, so this is internally a organization is doing, and I had told you that overall, okay, in the market, what is the cost of capital? We speak this as in form of KO. Okay, so this is all which we are going to use again in capital budgeting. Okay, internal rate of return, net present value. I'll explain you everything in detail. Interest rates, very important in order to understand the present value, future value. Then reinvestment axiom. This method is also used to assume that cash flow can be reinvested at the discounted rate in new projects. Now, what is that cash inflow? What is discounted rate? That also we will come to it. An objective. The present value method took to ascertain the amount which can be invested in a project so that its expected yields will exactly match to the repay this amount with interest at the market rate. Obviously, whenever I am investing a given amount, okay, if I tell you that my investment is 10 rupees and in return I am getting 12 rupees, obviously I will accept the project. But say if it is vice versa, I may reject the project. But how will I come to know about my investment and the return? Out sitting today, how will I come to know about 10 years? That is all what we have to ascertain. Okay. So, I am going to explain you all with the help of an example, with the help of a given question. Say suppose, okay, this particular question is going to solve all the kind of types, which are important to understand capital budgeting. Say there is a machine, it is costing me rupees 50,000. Okay, so today if I am going to invest 50,000, I have to pay. And this particular machine they have given me year 1, 2 and 3. It will give me an inflow of 30,000, 30,000, 30,000. Every year it is going to give me an inflow of 30, 30, 30. That means 3 years span is there. Should we accept the project? And then later on they have given me PV factor is 10%. Now understand PV factor means what? Okay, fine. I'll explain PV factor later on. Just to start with the basic. Okay. First method. I'm doing capital budgeting decisions method. Okay. So method 1. Method 1 is inflow and outflow method. Okay. Inflow and outflow. We will compare the inflow with the outflow. Now outflow in this particular example is 50,000. I have invested outflow, money going out from the organization. And inflow, if you see, is 30,000 for 3 years. That means 90,000 in total. Therefore, my net profit, okay, with the help of an inflow-outflow method, my net profit with this particular decision, inflow minus outflow. Inflow is 90, outflow is 50. That will become 40,000. Since my net profit is in positive, I will accept the project. Accept. Simple method. I am comparing my inflow with my outflow, and since there is a profit in it, I am going to accept it. Okay. Let's go to the method number 2. Another method is payback period. Payback period. Now, what is the meaning of a payback period? See, from a given company point of view, say, okay, I am a company. I am investing my 50,000 today on this particular machine. How many years will I take to recover my 50,000? Okay, because that is the actual cost. So, what will be the period in which my 50,000 will be paid back to me? paid back. Okay, my initial investment has to get recovered, no? So how much time am I going to take to recover that particular 50,000? Very easy. Payback period is nothing but your inflow total divide by your outflow, right? They have already given us the inflow 90,000. Now in this particular sum, inflow is remaining same every year. It can even change. Okay, in 1 year it can be 30, another year it can be 40. It can change. But my total inflow is 90,000. Outflow is 50,000. This is coming as 1.8. Now 1.8 means what? It is 1 year and 8 months. In 1 year and 8 months, I will be able to recover my entire 50,000. Okay, in this much period of time. Okay. Then coming to method number 3. Okay, method 3. Method 3 is known as benefit cost ratio. Benefit cost ratio. Okay, so financial management experts, they will remove this ratio and try to understand whether this particular machine should be invested or not. Okay, so my payback period is basically, if my this payback period was 1.8, if it is acceptable to the management, they are okay to wait for 1.8 or 1 year and 8 months to receive that amount back, it is fine. It will be upon the management to decide. But in case of benefit cost ratio, okay, now benefit cost ratio, again the benefit cost ratio, the formula is the same, inflow upon outflow. How much is the benefit over my cost? My benefit is 90,000 over the cost of 50,000. So my benefit cost ratio is 1.8 times. Easy, simple, these 3 methods. Okay, these are the 3 methods which we look at. And benefit cost ratio is obviously, here I can see it is greater than 1. Generally, this is what is the standard ratio. Okay, 1 is the standard ratio. Since it is greater than 1, I will accept the project. Okay. Now, all these 3 methods, if you go to see, okay, pretty simple, easy to solve. Okay, understanding that what is the inflow, outflow, number of years. But in this, there is one particular, drawback in these methods. We are not taking into consideration the time value. Time value of money, which is very, very important. Time value of money has to be taken into account to consider any given capital investments. Okay, capital asset investment, as I told you when we started the class, that capital investment are those which are going to be there for the years. Okay, it is a long term decision. It is not something which every year I pay rent, every year I am paying salary, something which is going to occur yearly. It is a decision taken once it is bought, it is irreversible. Time value has to be ascertained. Today I am investing, but my future, my inflows are going to start in the near future. Okay, so if I am telling you that 30,000 rupees is my inflows which will happen in the next 3 years, 1, 2 and 3 years. But what is the present value? Present value. If today I am investing, today I am investing 50,000 now. It is today this money is going out. So based on today, what is the current present value of this 30,000? 30,000 I am going to get after 1 year. This I am going to get after the end of second year. And this I am going to get at the end of the third year. So presently, what is the value of this particular inflows? That has to be taken into account. So these inflows, I have to discount them at a given interest rate. Discount at given rate of interest. Only then I'll be able to find the net present value. Okay, so now what is net present value method? So now I am coming up to the important method, net present value. All the sums, exam sums are based on these net present value, time value of money. Okay, time value of money. In this particular method, okay, please make a note of all this what I am writing. It is going to help you. Capital budgeting chapter is, as it is lengthy, you have to do the theory MCQs also, okay, as your revision. So if you are revising with me this practical MCQs, and I have taken all the past year exam questions, all the practical exam questions past year. So you will be sorted. Like today it will be done, your revision will be in and out over for capital budgeting. Once you read the theories and certain few theory MCQs here and there you will have to do. But otherwise all my MCQs of past exam questions are solved here. Okay. So net present value will be, it is a method, net present value method. In this method, okay, inflows and outflows will be brought to their present values, and then the decision will be taken. Okay. So how to bring these inflows or outflows to the net present value? Okay. Now they have given me in my sum my PV factor, present value factor, that means your rate of interest, I, or discounted factor, same thing. It is given at the rate of 10%. Alright. My present value of the outflow, present value of outflow. Currently I am investing today, T0, okay, is 50,000. Okay. Now I have to find the present value of my inflows. I am writing down here inflow, then your PV factor, and then your PV present value of your inflows. Okay. Year 1, 2 and 3. Inflow for all the 3 years is 30,000. Okay. Now I have to bring this inflow at today's value. Okay. Now you all need to know how to calculate. Okay. Lot of calculations are there in this particular chapter. You need to know how to operate your calci. Okay. Now what am I going to do here is, how do we divide? PV factor is 10%. Okay. Since it is 10% means you will do 1. Write down. You will do here for the PV factor. You will do 1 divide by 1.10. Since it is 10%, 1 divide by 1.10. How did I get that? It's nothing basically, but it is 1 divide by 1 plus your interest. Okay, this is what I am going to do. So it is 1 plus interest means it is 10%, 0.10. So 1 plus 0.10 is going to give me 1 divided by 1.10. Take that on your calci. 1 divided by 1.10 and press F equal to. You will get a particular number known as, I hope you all can see my calci. You will get a particular number known as 0.9091. Take up to 4 decimals. Keep that as it is. Okay. Keep that as it is and then again press equal to sign. You will get 0.8264 and again keep that as it is and press equal to sign and you will get 0.7513. Okay, once again I am repeating. This is important. Try to understand. I have to bring the inflows at today's value, present value. Okay. So I have to discount them at the rate of 10%. So this is an easy way of doing it. Alright. So in the first year, basically they are saying that, see, I will just give you one example, that today, and this is tomorrow, after 1 year, T1. Barabar? Year 1, they are saying that you are going to get 1 rupee. So this 1 rupee value, tomorrow I am going to get 1 rupee. No, so today what is the value? Okay, discounted at the rate of 10%. So what will be this amount? Okay, which will grow at 10% and become 1 at the end of that year 1. That is what I want to do. So basically what I am just doing is I am dividing 1 divided by 1.10. I will come to know that, okay, today if I am investing 0.91, then tomorrow I will get 1 rupee. Right? Same thing you have to do it for year 2 and year 3. So here, in the year 2, okay, end of the year 2, I am going to get 0. In the years T0, year it is going to be, in the starting of the year it is going to be 1 rupee. So end of the year it will be okay. So this is 1 rupee at the end of the year. So for us it is 30,000. If I am discounting that at 10%, so I am coming to that present value. Okay. Now that present value, if I will multiply that by my 30,000, I will get an answer as, you have to simply multiply, okay, 27,273. Okay. Then coming to year 2. Year 2 again, I will have to know that in order to get this 0.9091, okay, 0.9091 will be at the end of the year 2. So at the start of the year 1, it will be how much? Again, 1 divided by 1.10, that again equal to, when you will press, you will get 0.8264 into 30,000 will be 24,790. And then similarly, again you have to press equal to, you will get 22,539. These are the statistics formula, okay, in order to find the present value of 1 rupee at a discounted factor of 10%. Okay, so 1 divided by 1 plus I. Okay, the whole thing we generally do, this will be like whole thing raised to 3. We can do, it's a cumulative factor. I don't want to go into it right now. I will show you how to find the cumulative PV factor also. I will show you that. Okay, for all the 3 years together. Because the inflow amount is remaining the same in all the years, directly I can find the cumulative for all the 3 years and I can have an answer which is as a total. Here I am just doing it separately for 1 year each. Okay, so you will keep 1 divided by 1.10 on your calci. Press equal to, that will be your first year PV factor. Again keep that, press equal to second year PV factor. Again equal to your third year PV factor. Multiply by that PV inflow and then your answer will be total inflow will be 74,604. So now this inflow, I will compare it with my outflow in order to find the net profit. Okay, so net profit will now be PV inflow minus my PV outflow, or you can say discounted cash inflow minus discounted cash outflow. Same name, discounted cash inflows minus discounted cash outflows. So here my PV inflow was 74,604. My outflow is 50,000. So my net profit is 26, net present value 24604. Yes, 24604. I can accept the project still. Okay. So this was your method, that first method only, net profit method with the help of the net present value. My net profit changed because I have discounted my cash inflows. Now the second method was payback period. But here the name will now become discounted payback period. Discounted. Okay. So now how do I find the discounted payback period? Easy. Even this is very simple. Okay. Here we have already found the inflows. And then we will just do cumulative over here, so that it becomes easy to solve. Okay, so here 1, 2 and 3, my first year PV inflow, I'll take now all the net present value, 27273, then I have 24792, we just solved, right? 22,539. In cumulative, I will add up 24 with 27. It will come as 52,065. And then again in cumulative I'll get your total. Cumulative will be 74,604. Okay, now discounted payback period. My initial investment is equal to 50,000. Okay, now if you see in the second year, I am already crossing that 50,000. See the cumulative. I am crossing that 50,000 in the second year. That means in the first year, I have received an amount. In first year, year 1. Take this amount. 27,273. So now I am left with 22,727 to be received, balance in the second year. Okay, so now what is happening is, in the second year, I am getting 24,792. See, I am getting 24,792 in my full 12 months span, no? Total 12 months, no? Year, 12 months. So, in this 22,727, I will recover in how many months? I will have to just cross multiply, and here it will come as 11 months. Therefore, my payback period will be 1 year and 11 months. When I was doing it without discounting, the first method, It came as 1 year, 8 months. We had done that, right? I had done that for you all. I'm just showing it. We had done no method 2. It was simple, just we divided. Inflow divided by outflow. We can do the same thing over here also. But since we want the answer in year and months, I am showing you this particular method. In case it is being asked in the question, you will know that okay fine, this was also solved by ma'am. We can even do it in this manner. Simple it is. Okay. So if you see, why did I do the cumulative? Just to know in which year I am crossing my total outflow. This is just to know that. Okay, so initial investment 50, received the amount in the first year is 27,273. That means whatever balance is there, I'm going to receive in the second year. But when in the second year? In the first month, second month, after 4 months, after 6 months, what? How much? So I'm going to do cross multiplication. I'm receiving 24,792 in 12 months. So 22,727 I'll receive in how many months? That will be my payback period. 1 year, 11 months. Okay, clear? And then method 3, benefit cost ratio. Here the name changes. Here it is known as profitability index. Profitability formula remains the same. But since we are doing discounted cash inflow, it is known as profitability index. It is in the formula is PV inflow divided by PV outflow. Our inflow total is 74,000, right? 604 divided by 50,000. Our profitability index is 1 point approximately 5, 1.55. Okay. I hope this particular sum has been helpful to you all. Okay, you all have understood the basic concepts. Okay, basic inflow outflow method, getting a particular inflow to the discounted factor with the help of discounted factor, getting them to the present value. Okay, so this is what is all going to come. There are also additional questions and additional little bit of formulas here and there. When I'm going to solve the exam questions, I'm going to note down those formulas so that you will know how to solve those similar sums when coming in exams. Okay. Now, I told you I will also help you understand the cumulative cash flow. That I will see if there is one sum, and with the help of that sum, we can solve it on the calci and or do it together. I'm moving to the past exam questions. Okay, I'm not going chronologically. I'm trying to solve the ones which we have just done, the concept on which we have just finished. So let's go to question number 3 first. Okay, question number 3. Dash is the present value of an asset if the annual cash inflow is 1,000 per year for next 5 years and discounted rate is 15%. Discount rate is 15. Okay, so let's solve this. I'm just clearing this. Okay. Question number 3. The annual cash flow is 1,000. Okay. Number of years this inflow will come is 5 years. And my PV factor or rate of interest is 15%. They are asking me the present value of this cash inflow. Okay, so how will I find my present value? If I just wanted to do the total value 1,000 into 5, I'm going to get 1,000 rupees for 5 years. Okay, so 1,000 into 5, 5,000. But they are asking me the present value of my total inflow. So what will be my present value? Now since this is 15%, first I will do 1 divided by 1.15. Okay. Inflow, cash flow is the same, 1000 for all the 5 years. Okay, for all the 5 years my cash flow is remaining the same. Cash flow and year. 1, 2, 3, 4 and 5. Or for all the 5 years it is 1000. So either I can do 1 divided by 1.15 and then PV factor at the rate of 15%. Okay, like how we just solved in the sum. Either I can do that way, but that is going to take a lot of time. That we can do when the cash flows are different amounts. Okay, in a given year 1000, in another year it is 50,000, in another year is 4,000, 6,000. So if it is different, then yes, we can do cash flow for each year. We can do the discount factor. Now what was I doing for each year? I was doing 1 divided by 1.15, 1 divided by 1.15 equal to, okay, it will be 0.8695. Keep that again equal to, then 0.7561, again equal to 0.6575, again equal to 0.5717, again I'll press equal to 0.4971. This is what I can do. But in order to save time, and since the cash flow is also the same, I will do a cumulative one quickly. I will find a cumulative discount factor, directly total of the 5th year. So how is that done? 1 divided by 1.15. You will do equal to m plus, equal to m plus, equal to m plus, equal to m plus, 5 years, no, equal to m plus 5 times, and then directly press MRC. I'm showing you that in my calci. First clear your MRC. If it's coming on the screen, clear your screen of your calci. Do 1 divided by 1.15. Use your 2 fingers, equal to m plus 1, equal to m plus 2, equal to m plus 3 times, equal to m plus 4 times, equal to m plus 5 times, 5 years, and then press MRC. You will get 3 point cumulative factor. Okay, you will get 3.352 cumulative discount factor. Therefore, present value of my cash inflow is nothing but 1000 into 3.352, which is going to be 3,352 rupees. If you will solve with the point each year, okay, now in the exam sometimes ask you for 10 years. So it will become very difficult sitting and multiplying 1000 again and again. You will get the same answer. But try to do this. Okay, I'm showing this again. I hope you all please note it down. I have written it also for you all. Okay, what you have to do. Okay, clear your screen first. 1 divided by 1.15. Okay, 5 times I will press equal to m plus. So using 2 fingers, 1, 2, 3, 4, 5. Finish. MRC. I'll get a cumulative discount factor for that 5 years. Multiply that with my annual cash inflow. My answer is 3,352. Okay. Now I'm moving to the next sum. So we have solved question number 3. Okay. Coming to question number 6. What is the present value of an annuity of rupees 15,000 starting immediately today, T0, and paying another 5 annual installments, assuming the discount rate is 12%. Okay, same thing. Question number 6 I am solving. Okay. Question number 6. They are asking me, they have given me n is equal to 5 years. PV factor they are telling me is 12%. And they are asking me the amount they have given me, annuity amount. Annuity amount today is 15,000. Okay. They are asking me the present value. Okay, they are asking me the present value. Let's read the sum once again. Okay. What is the present value of an annuity of 15,000 starting immediately? Annual sum is paid. Okay, annuity is paid of 15,000 and paying another 5 annual installments. For another 5 years I am going to pay this installment. Assuming a discount rate of 12%, what is the present value of that entire annuity? Full. Okay. So sum is 15. So present value, how will I find out? At the rate of discount factor, it will be nothing but 15,000 into the discounted factor rate. How will I find the discount factor rate? 1 divided by 1.12 equal to m plus equal to m plus equal to m plus equal to m plus equal to m plus. For 5 years, no? MRC. That will come as 3.6047. Multiply that by 15,000. Multiply that by 15,000. Okay. I will get 54,070. Okay. But there is also one more. After 5 years I am going to get, means this will be the total payment. Okay, present value of the total payment in the next 5 years. But the present value will be 15,000 T0 plus this 54. You have to understand the question also. 54,070. So it will be 64,070. Okay, just give me a moment. See, it is question number 6. Present value of an annuity of 15,000. Present value we have to find. Annuity is 15,000 starting immediately T0. So that one is already there. And then there are 5 another annual installments. Okay, so actually total 6, no, but the T0 one is will stay at the present value, same 15,000. Value of 1 rupee today is 1 rupee only. Okay, so therefore I have added 15,000 to the amount which I did the discount factor to. Okay, so question number 6 is done. Now going to fine. Question 6 is done. Okay. Question number 7. If an investment of rupees 3 lakhs pays 25,000 per annum in perpetuity, what is the present value if the interest rate is 9%? Investment outflow is rupees 3 lakhs and inflow is 25,000 per annum in perpetuity. What is the net present value if the rate of interest is 9%? So now this is again a very easy sum. Okay. Question number 7. Investment amount. I am going really slow. Okay, because I want you all also to solve along with me. My investment amount is 3 lakhs rupees. My annual inflow is 25,000 rupees. Okay, rate of interest I is given at 9%. I need to know my present value of the inflow. For the perpetuity it is. Okay, so what will happen is present value of the inflow will be 25,000 divided by 9%. Generally, what is the formula? I have told you that net present value, how do we find? It will be net present value of the cash inflows. We do cash inflow into the discounted factor rate. Okay, at PV factor we do. Okay, so now in order to find the inflow, okay, in order to find this, I will just divide by PV. So 25,000 divided by 9%, that will give me the amount, that will be PV inflow amount will be 2,77,777. Okay, that will be my total inflow. Okay, total. Now net profit, net present value or net profit value will be PV inflow minus PV outflow. Inflow I have found out 2,77,777. My outflow is rupees 3 lakhs. So I am getting a negative 22,222 rupees. Okay. So here I have to divide my, see it is given me annual now. Otherwise I was multiplying, it was given total. Now this is an annual inflow. Okay, so annual inflow I am dividing by the PV factor which is 9%. So I will get the answer as 2,77,000. Okay, 777. Okay, and then with the help of that, my actual net present inflow or outflow, in fact it is negative 22,222. Okay, so question number 7 is also done. Coming to question number 9. Okay, a firm A is considering a project A. The project involves cash outflow of 50,000 today. Working capital, it will require some working capital of rupees 20,000 in the year T2 and is expected to generate a cash flow after tax of rupees 12,000 per annum for 5 years, excluding working capital release back and terminal value of 20%. So cash flow after tax we will get only for 5 years, but this particular inflow is excluding the working capital which is released and terminal value. Terminal means residual value. Okay, residual value of 20%. It is a very important sum. What would be your advice to the company by using the net present value approach if the cost of capital is 10%? Okay. Now understand something. Whenever I take a particular asset, okay, whenever I invest in a given project. So here my project A. Okay, writing question number 9. Project A. Okay, outflow is in the form of cost, which is 50,000. I have bought this particular project in 50,000 rupees today. T0. But now I just buy the machinery and keep it in my place, or I will need some or the other laborers to work on that machinery. I'll have to pay them the wages. There will be light, electricity which is used, power supply, water supply. So there is some working capital also involved, no, in order to get these inflows, which I will generate over the years. So this working capital is also an expense. Working capital is 20,000. T, in the year T2, it will get started, working capital. Okay. Then there, so total outflow basically for me, it is going to be actually 70,000. Okay. But this is going to begin in the year 2. So PV outflow, my rate, discounted factor rate I am just writing. I'll just write the given first. Cash flow after tax is given as 12,000 per annum. Okay. Number of years is 5 years. Then they are telling me terminal value. Terminal value is equal to 20%. Okay. And the PV factor is given as 10%. Okay. So first I will find my present value of the outflow. First is 50,000, which is the cost, and second one is 20,000 working capital, but it is going to start in the second year. So I will have to take the PV factor of 10% in the second year. So I will do 1 divided by 1.10, okay, equal to and equal to 2 times. Just press equal to 2 times. So it will be 0.8264. How did I get this? 1 divided by 1.10 equal to. 2 times just do equal to, you will get the answer. So this will be my discount factor. So 50,000 plus this 20,000 into 0.8264. I have brought that to the present value, right? So it is 66,520. Approximately. I have removed the decimals based on the MCQs given. Okay. Now, present value, inflow is done, of my outflow is done. Now I have to do of my inflow. Inflow will be cash flow after tax. That is how much? 12,000. I will have to take a cumulative factor for the 5 years. Okay, so that I will have to multiply. How will I multiply? I will solve this. 1 divided by 1.10 is equal to m plus 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 5 times MRC last. You will get the answer as 3.791. Please do it on your calci. When I am doing it, even you can do it. Okay. I am doing this 1 divided by 1.10 is equal to 1 is equal to m plus 2 is equal to m plus 3 is equal to m plus 4 is equal to m plus 5 MRC. Sorry. We'll do it again. 1 divided by 1.10 is equal to m plus is equal to m plus is equal to m plus 3.790. 5 times is equal to m plus is equal, and last will be the MRC. So my cash flow after tax present value is coming to 45,492. But this is not it. This is not only my inflow. I will also release my working capital. Whatever working capital is generally invested, working capital invested is always released. Okay, they will give you, it is always released. The same amount can be released always. If not the same amount, then they will tell you how much amount is released. Okay, generally working capital is released completely. Okay, that means I'm going to get the working capital of that 20,000. I'm going to get released. It is going to come back to me. So my working capital will come at the end of the 5th year. No. Okay. Yes. My working capital release will be present value of my working capital. Present value of the working capital released. Write it. Released. I had invested 20,000. Okay. I will take the PV factor of the fifth year, not cumulative, or in the fifth year, released after the project, in the end of the fifth year. So I will do into 1 divided by 1.10 is equal to 5 times. So do 1 divided by 1.10 is equal to 3 times, is equal to 4 times, is equal to 5 times. It will come as 0.621. So my working capital release will be 12,420. The present value of my working capital release will be 12,420. Also, there is a terminal value of 20%. That means this project is going to go in a, like how you sell a particular machine in a scrap. Okay, so I'm going to terminate at a 20%. I'm going to get some return. Okay, so PV value of the project terminated. Okay, terminated at 20%. So terminated 50,000 into 20%. Only 20% I'm going to sell in the scrap value, you can say. Again, that will be at the end of the project, at end of 5th year. Okay, this also will be end of 5th year. Right? So 50,000 into 20% is 10,000. PV factor I just did 10 times, 5 times, 1 divided by 1.10. So that will come to 0.621. So this will be 6,210. Therefore, I have 3 inflows at the end of the project. Okay. One is the yearly inflow discounted. One is the working capital discounted, and one is the scrap value which I have discounted. Therefore, total inflow will be equal to 45,492 plus 12,420 plus 6,210. That will come to 64,122. Therefore, at per the net present value approach, inflow, PV inflow minus PV outflow. PV inflow is 64,122. PV outflow also I have calculated 66,520. Okay. So 66,520 I am getting NPV negative minus 239298. So I am going to reject the project. Let's see whether should accept, either reject or accept as the NPV 0. Reject the project, information is incomplete. Answer is reject the project. Is the NPV 0? No, it's going negative. Accept, we cannot. Is the information incomplete? No. Obviously, we have to reject the project. Okay. Now going to question number 10. A firm expects an NPV of 8,000. If the economy is exceptionally strong, 30% is the probability. They expect an NPV of 4,000 if economy is normal, 40% of the probability. And if NPV of 2,000 if economy is exceptionally weak, 30% of the probability. Expected net present value is how much? Okay, now they have given you the expected value, the net present value. But the probability is, if the economy is strong, probability is given as 30%, 40% and again 30%. So this NPV, okay, question number 10. Okay, NPV. They have given me 8,000 expected NPV, expected. Company is expecting this much. 4,000 and the last one is 2,000. But the probability to earn this much of NPV is 30%. This is 40% and this is also 30%. Okay, so what I will do is simply I will multiply my NPV with the probability. I will get the expected NPV now. Actual expected NPV. So 8,000 into 30% will be 2,400, 1,600 and 600. So actual expected NPV is going to be 4,600. This will be your answer. So simple. Just whenever they ask you anything with the based on probability, you have to multiply the expected NPV with the probability. You will get the expected net present value. Clear? Now the next one. Don't worry, the sums which I am leaving right now, I am going to solve them at the end of our session, okay? Because they are a little bit different. They are based on simple interest, compound interest, but we will be solving. Question number 12. MNP Limited is considering the purchasing of an asset which is costing 80,000 and having a useful life for 4 years. During the first 2 years, the incremental after-tax cash inflow is 25,000 per annum, and then in the last 2 years it is 20,000 per annum. What is the payback period of this particular investment? Okay, they have not given me any discounted factor, interest rate, nothing. Okay, so easy. Question number 12. Okay, read the questions properly in the exam. Okay, one way of clearing and getting the right answer is, you all don't read the question. You all just want to jump into solving. Don't do that. Just read the question 1-2 times. They have given you all cash flows for 4 years. Okay. First 2 years it is 25,000 and then another last 2 years it is 20,000. Okay. So this is going to be 50,000 plus 40,000. Okay, divide by, you have to get an average of it. Okay, so divide by 4 years, no? 4 years, right? So 90,000 divide by 4. I just did simple, I just did total. Okay, so even this also is like confusing to you all, no? So I will write your average cash flow. Average annual cash flow after tax is equal to, first year it was 25,000, next year also 25,000, then another last 2 years which are left 20,000. So 4 years average, divide by 4, so you'll get 22,500. They are asking me my payback period. Payback period is nothing but your internal initial investment upon your average annual cash flow. So my initial investment they have given me 80,000. Okay. And my average annual cash flow is 22,500. So this is going to come to 3.5 years. Simple. This is what you all have to do. Okay. Payback period, there is no discounting factor, nothing. My investment is 80,000. Average I am going to earn 22,500. So 3.5 years. Okay. Coming to your next question. Okay. There is a project named ABC. They have following cash inflow for 4 years. They have already given me the cash inflow. 34,444, 39,877, 25,000 and 52,800 respectively. Initial investment made was 1,04,000. Find the correct statement from the following. Present value of an annuity of ₹1 on various discounting factor. They have given me various discounting factor at 9%, 13%, 15%, 16%, 17% and 18%. Okay. In the 4th year, directly in the 4th year, they have already calculated that and they have given it to me. So they are telling me what is the correct statement. IRR is less than 9% or whether IRR is greater than 9% but less than 13%. IRR is greater than 16% but less than 18%, or IRR is greater than or equal to 17%. Now what does IRR mean? Okay. IRR means internal rate of return. Okay. IRR, internal rate of return. It is that discount factor or that rate of interest or a PV factor at which when you will calculate your cash flows, your NPV, net present value, will come to 0. That means you are able to earn only that particular, your inflow and outflow are the same, almost the same. Okay, your inflow, when you are discounting that means you are able to earn only that much at that particular interest rate, and your outflow remains the same, it is 0. So your NPV, when it is 0, that will be the correct internal rate of return. Now in case of internal rate of return, we have to do some trial and error method. Okay, now they have given me 4 years, year 1, 2, 3 and 4. Okay, they have also given me the amount. They have given me 34,444, 39,877, 25,000 and 52,800. Okay, now what am I doing is, I am first trying to, they have not told me, they are just telling me that what will be my IRR, kind of, the question is. Okay, where my outflow, so they have given me 1,04,000. That means I should get an inflow also of 1,04,000 around. Okay, so what am I doing is here, just a second. Okay, so what am I doing here is, I am going to start with the PV factor. They have given me 16%, 17%. Okay, then they have given me 18%, 15%, 13%, 9%. Okay, I am starting it from the last ones. Okay, 16%, 17%. It's a trial and error method. Okay, so when I am doing it with the help of 16%, okay, that means 1 divided by 1.16 actually. Since the amounts are different, I will have to do it for each. So 0.862, it will come to 0.743, 0.641 and 0.552. And then I have to calculate that, multiply, and I'll get PV inflow amount. Okay, so when you will calculate, this will be 29,691, then 29,629, 16,025 and 29,146. So see, the inflow coming is 1,04,491 PV inflow. My PV outflow, they have given me 1,04,000. That means I have a negative NPV I have a positive NPV. Inflow minus outflow, right? Correct. I have a positive NPV still, which is 4,491. 4,491. That means I'll have to use a higher PV factor. Only then my PV inflow will, if I'll use a higher PV factor, only then my NPV amount will come down. Okay. So if I am using a higher PV factor, then I will say at the rate of, try to take 18%. Just go to two more PV factors above. Okay. So when you will do it at the rate of 18%, 1 divided by 1.8. Okay, 1 divided by 1.18 equal to, you have to do it for 4 times. So I'm getting 0.847, again equal to 0.718, again equal to 0.608, again equal to 0.515. Okay, I have to multiply this amounts. 39,877, 25,000, 52,800, 34,444, 39,877, 25,000 and 52,800. Okay, let's multiply and check. 34,444 into 0.847, that will come to, even I am doing trial and error, 714. Then 39,877 into 0.718, say 28,631, or you can take 632. 25,000 into 0.608, 15,200, and 52,800 into 0.515, 27,192. Now let's total this. 29,174 plus 28,632 plus 15,200 plus 27,192. Okay, it is coming 1,00,198. Okay, so now that means it is not 18%. Again, why? Because see now what is happening, PV inflow and PV outflow. If I'll subtract my PV outflow, it is coming to 3,802. That means it is somewhere between 16 and 18. That means 17%, Okay. So IRR, I can say that it is greater than 16% but less than 18%. Because if you will try to do with 17% also, you will not get 0. You can do it with 17%. So this will not be your answer. IRR cannot be less than 9%. This is gone. It cannot be. A and B are not the option which can be considered. Okay. So your last, the third option, the IRR is greater than 16% but less than 18%. It is a trial and error method. Okay. Now come again to our next question. We are done with this particular. I know this is a little lengthy sum. So I will just suggest that this was one sum asked in all these attempts. Okay, so this was once, but I have done that so that you all don't miss out onto anything. Okay, there is one more small sum on IRR, but in that the options are given in such a manner that obviously you will know that what is the answer to this. Okay. Now the next question number 14. Mohan Pizza Limited is considering purchasing of a pizza oven. The expected purchase price, outflow, is 2,70,000. Expected annual revenue from the oven will be 1,50,000. Expected annual costs are 90,000, including 22,500 of the depreciation. The investment has a payback period of approximately what? They are asking. Okay. So, I will do your question number 14. Annual cash inflows. Okay, inflow will be your annual revenue. They have given me. From that, I will have to subtract my annual cost. And whenever they are giving you depreciation, always add it back. Now, why so? Depreciation is a non-cash expense. There is no actual cash moving out. We show it as an expense, but do we really remove that amount? I'm sorry. But the depreciation amount always you are supposed to add it back. So my annual revenue is given to me as 1,50,000. From that I will subtract my annual cost of 90,000, but I will add back my depreciation of 22,500. So my total will be 82,500. Okay, cash inflow. Now my payback period will be investment, your initial investment upon your annual cash inflow, cash flow. Okay, investment is rupees 2,70,000 initial investment outflow upon 82,500. So that will come to 3.27 years. Okay, that is also given in your option. Right, payback period done. Payback period now understood. It is easy to solve. Now question number 15. ABC Limited has an estimated cash inflow for 3 years. They have given 1, 2 and 3, 500 lakhs, 1200 lakhs and 1500 lakhs respectively. The profitability success is 0.7, 0.65, 0.75. PV factor is 10%. For the all 3 years they have already calculated and given it to you. Initial investment is 1500 lakhs. What was the expected NPV? Now again I had told you, whenever they have given you the profitability or probability ratio, you have to multiply your cash flow with that probability. Okay, so question number 15. Here they have given me 1, 2 and 3 years. They have also given me my cash flows in lakhs. 500 lakhs, 1200 lakhs and 1500 lakhs. But there is a probability which is attached to it. 0.7, 0.65 and 0.75. Therefore, my actual probable cash flow, okay, expected or probable cash flow will be 500 into 0.7. That will come to 350. 1200 into 0.65, 780. And 1500 into 0.75, 1125. Now with this particular probable cash flow, I will apply my PV factor at the rate of 10%. Okay, you don't need to do anything. They have already given you 0.750. Just multiply your probable cash flow with your PV factor. So your PV inflow will be, cash inflow will be 318.15, 644.28. All these amounts are in lakhs. 843.75. Okay, so 1806.18 is your PV inflow. PV outflow they have given you as 1500. Therefore, NPV, expected NPV, will now be 306.18. Clear? Easy sums. Okay, the more you will practice, obviously you will find it easy. Question number 16. The initial investments required for project A and B is 1 lakh each, both same. Present value of future cash flows. Present value of future cash flows is 1,15,500 and 1,19,500 respectively. The profitability index of project A and B are how much? Okay. Question number 16. Projects A and B. Outflow is the same, 1 lakh. Okay, PV outflow. And PV inflow. Present value directly they have given me. One is 1,15,500 of A and 1,19,500 of B. Therefore, probability index. Okay, probability index, I will do it here only in form of chart. Probability index formula is what? PV inflow upon PV outflow. So, probability index of A is 1.15 and of B is 1.195. Let's see, this is the answer. Option number B. Simple. Okay. Now let's go to the question number 17. Initial investment of a project requires 5 lakh rupees. Expected annual cash inflow is 90,000 for 10 years. Determine the payback period. Again, payback period, you see. Payback period is important. Question number 17. Initial investment is equal to 5 lakhs and my cash flow is going to be 90,000 for 10 years. Okay, I'm going to get 90,000 for 10 years. Do not multiply. But for 10 years, 90,000 will be my annual cash inflow. So, my payback period will be initial investment upon my annual cash flow. Initial investment is 5 lakhs. Annually, I am receiving 90,000. That means it will be 5.55 years. But the options are in months, year and month. So, now I'll have to see that. Okay. So, 5 years, total 5 years plus 0.55, I will just multiply that by number of months, 12. Okay. So, that will come to 0.55 into 12. It will be 6.6. Okay. So, 5 years plus 6.6 months. But now there is nothing in the option given as 6.6 months. 6.6 months approximately comes to 7 months. Approximately, 7 months. So, it is basically the answer is 5 years plus 7 months. The option is there. 5 years and 7 months approximately. Okay. So, question number 17 done. Okay. Coming to question number 18. GRI Company Limited decided to invest in a plant and machinery 650 lakhs and the life is 5 years. At the end of the 5th year, the residual value which is estimated is 3 lakhs and disposal expenses are 1 lakh only to dispose of this plant and machinery. There are some expenses. Estimated inflow is 75, 90, 110, 125, 140 respectively. PV factor 9%. For 1 to 5 years is already given to us. We do not really need to put anything on the calculation. Okay, so your question number 18. Okay. I'm just writing the given. Initial investment is 650 lakhs. So that is my PV outflow. Okay. N is equal to 5 years. There is a residual value. Residual value is 3 lakhs rupees. But there are some disposal expenses in order to put this into scrap. So disposal expenses is 1 lakh. So if I go to see, my actual residual value will become 2 lakhs. Actual residual value. Right? I'm just writing all this given and given. Now here there are 5 years. 1, 2, 3, 4 and 5. Okay. They have also given me my inflow. 75, 90, 110. I have 125 and 140. PV factor at the rate of 9% they have calculated for each year and given it to me. 0.9174, 0.8417, 0.7722 it's given, and then 0.7084. Okay, and the last year is 0.6499. 0.6499. Okay, I have to just multiply my inflow with the PV factor, discounted factor. PV inflow will be 68.805. This will be 75.753, 84.942, 88.55, 90.986. Okay, but in the last year plus at end of fifth year, I have also received another 2 lakhs rupees. Okay, 2 lakhs inflow. Discount factor of the end of the fifth year is the same, no? 0.6499. So that is going to become 1.2998. So totally my PV inflow is coming as 410.33. My PV outflow is 650. Therefore, my net present value is coming as minus 239.66. Okay, minus 239.66 is my answer. Okay, you all can check this in the past exam questions. I have already given you the year in which they have asked and what they have asked. Okay. Now coming to question number 19. Ravi and Sam invested in equity market 2 lakh each, and Ravi invested in manufacturing sector and Sam invested in IT sector at the end of the year. Overall yield from the manufacturing sector is 4.75 and in the IT sector it is 7.25. Alternatively, bank interest, okay, is giving a yield of interest of 6.75% in the term deposit. Calculate the loss or gain to Ravi and Shyam. Okay. Question number 19. Okay. So each of them, Ravi and Shyam, both have invested 2 lakh rupees. Ravi and Sam. 2 lakhs both of them have invested. First I am finding of Ravi. He invested 2 lakhs rupees. In which sector? In the manufacturing sector, which was giving him 4.75. If he would have invested in the term deposit, it would have given him 6.75. So what he has invested, I am comparing that with what they are asking for. Okay, what would be the loss or the gain? So I am comparing that with the term deposit. So basically I will do 2 lakhs into minus 2%. No, don't do minus 2%, but 2%. I have to multiply that by 2%. So I am getting 4,000. But this 4,000 will be minus loss. He has invested in the manufacturing sector, which is giving 4.75 only. If he would have invested in the fixed deposit, term deposit, he would have got 6.75. So Ravi is having a loss. Similarly, I will do of Sam. Sam also invested 2 lakhs. But in case of IT, he is getting 7.25. And term deposit is standing at 6.75. So 2 lakhs into 0.5%, that is going to be 1,000 gain. So the answer is Ravi is at a loss of 4,000 and Sam is at a gain of 1,000 rupees. Okay. Now coming to sum number 20. Shaktiman Incorporation, considering a project that requires 4 crores as initial investment, it is expected to generate annual cash after tax cash flows of rupees 60 lakhs for 12 years. Shaktiman's weighted average cost of capital is 14%. This project's net present value and the approximate internal rate of return, 2 things, net present value and IRR, they are asking. Alright. Okay, so now question number 20. Okay, annuity factor. Okay, your PV factor is 14% for 12 years. Okay, so I will do 1 divided by 1.14 is equal to M plus for 12 times. And then MRC. So my cumulative PV factor will stand at 5.66. Okay. Now my net present value is nothing but cash inflow, PV cash inflow minus PV cash outflow. My PV cash inflow, I am making an inflow of 60 lakhs rupees per year. 60 lakhs. Per year, I am multiplying that with a discounted factor and my outflow is 400 lakhs today. So this is 339.6 minus 400. Okay. So minus 60.4 lakhs is my NPV. And they are asking me my IRR. IRR means at that rate of that PV factor where NPV will become 0. Okay, so obviously I have to go beyond 14%, less than 14% to get the NPV 0 because my answer is coming in negative. Okay, so if you see the answers which they have given, okay, A, B, C, D, my NPV is come to minus 60 lakh 40,000. At 14%, so already it is coming only. So IRR cannot be 14% because NPV is coming negative. That means IRR has to fall below 14%. Okay, less than 14%. So IRR should be 10%. So option is A because the rest two, the NPV is not the correct one. So basically I had to choose from this two. Discounting factor 14% if I am doing, okay, it is going to become more. 14% I have already done. Okay, I have already done 14%. Weighted average cost of capital is 14%. Based on that only I am getting negative NPV. That means the discounting factor is really too much. I have to reduce that. So it will be 10% approximately. Okay. Now coming to the other types of the questions. Okay. These are all based on your present value of a given sum invested, etc., etc. The compounded half yearly, compounded annually, compounded quarterly. Okay, they are trying to tell us to find the present value or the future value. Okay, so these are the now remaining sums. Okay, time value of money sums which they are asking in capital budgeting chapter. Okay, so let's move to question number 1. All the balance remaining questions I am solving. Okay, what will be the maturity value? Now these will have a little, you have to write down the formula also. What will be the maturity value of a sum which is 18,000? 18,000 is the sum. I am investing that today, 5% per annum for 10 years. So what will be the maturity value? They are asking. Simple. Question number 1. Sum is equal to 18,000. N is equal to 10 years. And I is equal to 5%. Right? So my maturity value will be equal to the sum invested into 1 plus I, the whole thing raised to n. Sum is 18,000. 1 plus I is 5%, that means 0.05 raised to n, that is 10. So 18,000 into 1.05 raised to n. That means 1.05 you will have to do it 10 times. Multiply 1.05 into 1.05 into 1.05. Like that you have to do 10 times. I can show you one small shortcut. You can do 18,000. Okay, write the 18,000. What you can do on your calci is, you can do 1.05 into 1.05. And since it is 10, do equal to 9 times, 1 time less, because already I have multiplied, no? 1.05 into 1.05 I already just did on the calculator. So that 1 is already gone. So now just do equal to 9 times. 1, 2, 3, 4, 5, 6, 7, 8, 9. 1.6288. And it is actually correct. Okay, so directly 1.6288. So how did I get that 1.6288? You can write it down. I did 1.05 into 1.05 and I pressed equal to 9 times. Okay. So now 18,000 into 1.6288 will come to 29,320. Okay, so maturity value. Okay, this is the kind of future value, maturity value, future present value of the maturity value. Maturity value of some number 18,000. If I am discounting in this, so this will become like a present value of your maturity value, right? It is also known as future value, or you can also tell this as a maturity value. Understood? Okay, this is one. Please write down this particular formula. Okay, going to the next sum. Given that the effective rate of interest is 9.31% per annum, what is the nominal rate of interest per annum if compounding is carried out quarterly? Means interest I am going to compounding means I am going to get 12% over the 12 months. But if I am getting interest in every quarter, I am not going to get 12% every quarter. It will be 12 divided by 4. I am going to get 3% of interest in my entire year, that will complete my 4 quarters. Okay, that is the meaning. So question number 2. Rate of interest is 9.31%. So I am making this as 90.0931. Okay, just I make it in the point form. Okay, this is compounded quarterly. Compounded quarterly. Now effective annual rate, annual interest rate will be equal to 1 plus the interest rate upon n raised to n. Now compounded quarterly means n is equal to 4 minus 1. Okay, I'm assuming the sum to be 1. So here my effective annual, this they have already given me. I have to find the actual rate of interest, I. One plus I do not know my I. N is 4. The whole thing raised to 4 minus 1. Now I'll take this minus on this side. So it will be 0.0931 plus 1. Okay. Plus 1. And this will stay as it is. Raised to 4. Okay. So now when this, I want to raise this raised to 4, I want to take it on the other side. I'll have to take it as a square root. So I will do square root 1.0931. But not only square root means 2, no? So I'll have to do it twice. Because this is raised to 4. So I'll have to do square root twice. So what you can do on your calci, 1.0931 square root, press square root twice. Okay. So this 4 will go from here. Since I am taking 4 on the other side, it is raised to 4. Now I'll have to make this particular number as a square root. But I'll have to do it twice. Okay. So when I'm doing square root of 1.0931 twice, I'm getting the number as 1.0225. Okay. Here you can do minus 1. Take this 1 on the other side. Also take the 4 on the other side, multiply, that will become I. Okay. When you will solve this, it will be 0.09, which will be I. Therefore, I is equal to 9%. Actual rate of interest is 9%. Effectively, it is coming to 9.31. Okay, so please write down this also formula. Okay, this formula is also important. There are more sums. You will get a practice of it. Nothing to worry. Now the next one. So I'm done with question number 1 is done, 2 is also done. Okay. I've already done sum number 3. The effective rate of interest for a sum of money which is compounded quarterly is 12.55%. What is its nominally? What is the nominal rate of interest? Same question again. Just the number is different. Okay. So the effective rate of interest of a sum which is compounded annually or quarterly. So n will be 4, the whole thing raised to 4 minus 1. So they are giving me effective rate of interest is 12.55%. I have to find the nominal or actual rate of interest. 12.55 means 0.1255. I am taking the 1 plus 1 I am doing here. This will be 1.1 I upon 4, the whole thing raised to 4. Then taking the square root of 1.1255 twice. When I'll do that square root twice, I'll get the answer as 1.0299 minus 1. Multiply that by 4. That will become I. Okay, so 0.1196 is equal to I. Therefore, approximately it will be 20% effective rate of, nominal rate of interest. Effective is 12.55. Nominal or actual rate of interest is 12%. Simple. Okay. Now question number 5. The price of a share is 100 rupees today. It grows to 125 at the end of the first year, and then 187.5 at the end of the second year, and 243.75 at the end of the third year. What is the average rate of return? Okay. Now certain questions are as a surprise. Okay, surprise element. But they are to apply your basics. Okay, now see in year 1, first year. Price today was 100. Okay, PO. PO is 100. Okay, it has grown and it has become 125. So basically, if I want to find the increase, it will be 125 minus 100 divided by the base PO, 25% increase in percentage. In the second year, from 125, PO was 125. It went and became 187.5. So again, I want to find the percentage. For me now, the base amount will be 125 rupees, right? Into 100. Okay, I'll always multiply by 100. That will become 50%. And in the third year, when my PO was 187.5, it went ahead and it grew to 243.75. Multiply this by 100 in order to get the answer in percentage form. This will be 35%. No, sorry, 30%. Okay, every year rate of return, I have found the growth rate of return. They are asking me average rate of return. Therefore, average rate of return will be 25 plus 50 plus 30 divided by 3. That will be 35% is the answer. It seemed to be so difficult, no? The question, it grows to 125, grows to 187.5. But you have to just be confident, read your questions well, and you will be able to solve these sums. Okay. So done with question number 5. Now coming to question number 8. Okay. A sum of rupees 50,000 is invested at 12% per annum for 6 years. What will be the present value of its maturity value, assuming a required rate of return of 10%? They are asking me present value of maturity value of a given sum. So first I need to know what is the maturity value. Now only then I will be able to find the present value of that particular maturity value. Okay. So question number 8. Okay, the sum is equal to 50,000. Okay, I have to first find the maturity value, and interest is 12% and N is 6 years at the rate of 12% for 6 years. All the three given I have written. Maturity value will be how much? I will get 50,000, 1 plus I, the whole thing raised to N. I am going to receive 12% interest every year. So 50,000 into 1 plus 0.12 raised to 6. 50,000 into 1.12 raised to the 6. Okay, that means I have to multiply. So what I will do is, I will do 1.12 into 1.12 and then I will press equal to only 5 times. Okay, equal to 5 times. Press equal to 5 times because it is raised to 6. 1.12 is already gone. So 1.12 into 1.12 equal to 1, equal to 2, equal to 3, equal to 4, equal to 5. Correct. So I am getting 50,000 into 1.9738. Okay, I will show you on my calc what I did. I am doing 1.12. I have to multiply 1.12, 1.12 6 times. I have to do like that. Into 1.12. Already once it is done, 6 times karna hai. Only once it is done. Only now 5 times is pending. So press equal to 5 times. 1, 2, 3, 4, 5. 1.9732. Okay, so when you will multiply this, you will get an answer as 98,700 approximately. Okay. Now they are asking me the present value of the maturity value is equal to how much. Okay, so now this maturity value I will have to multiply by the PV factor. PV factor they are saying assuming the rate of return is 10%. So here I will take 10% of the fifth year for the sixth year. How will I take for the sixth year? 1 divided by 1.10 is equal to, I will do 6 times. 3, 4, 5 and 6. Okay. I don't have to take cumulative. Won't do m plus. Just 1 divided by 1.10. 6 times. 1, 2, 3, 4, 5 and 6. 6 time on your calci it will come as 0.5644. So your maturity value is 98,700. Multiply that by PV factor. So present value of your maturity value will be 55,667 rupees. Present value. Okay, of my maturity value. Important sum again. There are this type of sums. Okay, question number 8 is done. Again, same thing. Question number 11. What is the present value of the maturity value of a sum of rupees 10,000 which is being given on an interest at 15% for 5 years and the required rate of return is 10%. Now PV factor of 15% they have already given me and PV factor for 10 years of 10% after 5 years is also given to me. So I don't need to do anything on the calci for that. Okay, but again simple sum. Question number 11. See now, imagine all this is already given to you. So I have to first find my maturity value. Will be sum into 1 plus I whole raised to n. Okay. So the sum is 10,000. 1 plus interest is rate of interest. I they have given me at the rate of 15%. Investment is done at the rate of 15%. Okay. So I is 15%, N is for 5 years. So 15% means 0.15 raised to 5. So 10,000 into 1.15 raised to 5. They have given me that the PV factor for 15% is already given 2.01136. So I will multiply 10,000 by 2.01136. So my answer will be 20,103.6. That is my maturity value. I have to find the present value of my maturity value. So what I'll do, present value will be maturity value into the PV factor at the rate of at the rate of 10%. Okay. Now in the sum what has happened is they have given you after 5 years is 1.61051. Okay, of this 10%. Right? So what you can easily do if you want to, what you can easily do is you have already found your maturity value. So PV factor is already given to me. Okay, PV factor here it is given to me. Maturity value I just found. I want to find the present value. So you can do maturity value upon the PV factor. 2113.6 upon 1.61, what they have given is 051. So you'll get the answer as 12,488.94 because they have given you after 5 years. But if you want, like how we did in the previous sum, present value, I did maturity value into PV factor at the end of 5th year. At the end of 5th year. So in that case, you can do 1 divided by 1.10 is equal to 5 times. So then you will get 20113.6. PV factor at the end of the 5th year will come to 0.6209. So again the answer will come the same. So if in case you are taking the PV factor after 5 years, okay, then do it divide the maturity value with that. So you'll get the correct answer. Otherwise, you can do your PV factor in this form. You will get the correct answer. Okay. I have given you both the ways. Even 14th sum is done. All the sums are done. Last two ones are left. 21 and 22. Find the amount of annuity if payment of 50,000 is made annually for 7 years at an interest rate of 14% compounded annually. Okay. Question number 21. Na? So amount is 50,000. Then we have N is equal to 7 and I is equal to 14%. Find the amount of annuity. Okay. Find the amount of annuity if payment is made 50,000. Okay. So the amount will be equal to maturity value, you can write over here. Okay. It will be amount into 1 plus I, the whole thing raised to N minus 1 upon I. Amount is 50,000. Okay, principal amount. Okay, the compounded interest formula this is. Okay, 1 plus I is 0.14, the whole thing raised to 7 upon 0.14 minus 1. So 50,000 into 1.14 raised to 7 upon 0.14. So you'll have to calculate this. 50,000 1.14 raised to 7 means multiply that by 7. 7 times you have to multiply 1 by 1.14 into 1.14. So 1, 2, 3, 4, 5, 6. I've done it 6 times. Do 1.14 into 1.14 and then put equal to sign 6 times. You will get 2.5022. So 2.5022 minus 1 upon 0.14. This will come as an answer will be 5,36,500 when you will solve it. Okay. So this is the amount formula. Amount is equal to principal plus, okay, the amount which you are going to get after the maturity after 7 years. So the sum invested for n number of years at a given rate of interest. Now the last sum, the present value of 1,000 to be received after 1 year at the rate of 8% per annum is 926. Present value they have already given of 1,000 and shall receive after the 1 year. If discounted half yearly, the present value would be. Okay. So question number 22, the last exam question to be solved. Face value is equal to 1,000. Okay. Future value is equal to 1,000. Sorry. N is 1 year. Rate of interest is 8%. Okay. Compounded half yearly. Half yearly. So basically what happens, my N now becomes 2. Okay. Now let's solve this. So present value will be equal to the sum into 1 upon I, the whole thing raised to n. So 1000 into 1 divided by 1 point. Okay. Since it is 8% compounded yearly, compounded half yearly, I will become 4%. So it will become 1.04, the whole thing raised to 2. Okay. So 1 divided by 1.04 divided by 1.04 is equal to 2 times yield into 0.9245. Therefore, the answer will be 924.55 rupees. So, if it is compounded half yearly, the answer is going to be the present value of rupees 1000 to be received after 1 year at the rate of 8% is 926. But if it is discounted half yearly, 8% will now become 4%. The present value will now be 924.55. Okay, so I hope you all have taken a note of all these new type of formulas. Okay, if any this type of sum is asked, it will be very easy for you all to solve. You will be like, okay, yes, we have already done this and solved it. Okay, so thank you everybody. But just before ending the lecture, I would like to request all that please join our Telegram group and join our WhatsApp group. The link of both the groups are given in the description. Download our Jahangir Tutorials app for for seeing the further lectures. If in case you want to keep your app in your mobile, you can have an access to all the notes and videos. Also subscribe to our Jahangir Tutorials channel. I'm also going to come up with such revision lectures and videos for other chapters and subjects as well. So to stay tuned, say subscribe. Okay. Thank you everybody once again. Bye bye.